And we are live. Good to see everyone. David, hopefully you're liking the better time, my friend. Andrew, good to see you. Hello, hello, hello. Can anyone explain to me what Upstart does? Yeah, I can. Maybe we should do it today, eh? Maybe we'll do it live. Who could have ever guessed, eh? No, I all sarcasm aside, I'll be talking about that for sure. Okay, so why don't we get started? First off, for the people that may not actually know what Upstart does, we can go through it. So, essentially, it's dark and raining here in New York. Well, it was for me, so maybe all the clouds had head south from, when it was raining here. But let me get back to it. Good to see you, Matt Flo. Okay. Essentially, Upstart is a algorithm. They take in a ton of data about what they said this quarter, about 70 billion cells of performance data, averaging about 88,000 new loan repayment data each and every business day. Okay. They take that data and they try to price out loans better than the average bank or credit union. So what ends up happening is they take on a bunch of applications from people that would usually be submitted to banks, get submitted to Upstart, and they have a way of approving loans for companies like banks and unions. They don't actually take on their own risk. They just do the risk assessing. Then they go off and take that loan and sell it to a bank or credit union that might want a loan that performs better than what they might have actually underwritten themselves. That is essentially the 30-second sell, okay? Getting into the actual numbers of it, they like to push themselves as being much more efficient than average banks. This quarter, however, as they are crashing down, the stock just recently hitting a 52-week high of, what was it, $72.58. Today, they closed out at $32.05. That's a 56% decrease in the stock in the matter of just a couple days after it's shown off their Q2 numbers. Must have been terrible. There's definitely some numbers in there that I didn't like. The more I go diving, though, there are small, intricate details within the quarter that I really do not like. But we'll talk about all the goods and the bads, the actual numbers that they put out, revenues, net incomes, adjusted EBITDA to be very specific, contribution margin, operating expenses, fully autonomous loans. All of those statistics blew me out of the water. Very, very good signs. Things were looking great. Even Oscar Chan here in the chat said it perfectly. Macro market is performing bad. Okay, so they weren't necessarily expecting to do amazing things either, and people know that. But like David T in the chat said, Pagaya earnings were good. So is this a matter of being a macro problem, or is this a matter of just terrible execution from management? Now, Pagaya, if you haven't heard, very similar, okay? They do AI automated loans, help the underwriting, sell it to large banks like, SoFi, Ally, a bunch of other big financial institutions there in America. Now, to go back to Upstart, however, I don't know if you guys have seen this. I kind of have a spreadsheet going out throughout all of these numbers. So the amazing thing about being the company that just looks at loans and doesn't actually need the capital to do so, you're not dealing with one bank, you're dealing with 100+ banks, that your growth can be quite fast whenever, let me see if I can bring this way up. Boom. Okay. Let's look at just the last couple of quarters. So as the macro environment was just absolutely deteriorating, so was Upstart, falling dramatically whenever it came to their revenue. Total amount of loans that they were actually signing was going down the drain, okay? Along with it, the quarter-over-quarter changes were drastic. So this is a very speculative position. It's not diversified at all. They have a very focused style of business, and that's what took their stock price from like, what was it? Here, wait, let me see if I can find it for us. Oh, not IR, sorry. I'm so used to typing IR. That's hilarious. Not years, sorry, 5 years. Yeah, so they actually touched $400 at one point. I know it says 390, but they did actually touch the $400 mark back in October 2021. Then actually just reaching $32 very recently. I think at the low they were like $15 or $12, something like that. They might even, yeah, $11 actually, $11.93 as a low. So 400 down to $11.93. Absolutely insane. Okay, insane. Tanner, this is Henry. Keep in mind, Upstart only uses 1/4 their committed capital they received in Q1 to achieve 31% revenue growth quarter over quarter. It appears now they're conserving that for better times. Hey, Henry, if you want to chat, my friend, you have an opportunity to do so. If you want an invitation to this, okay, I'll invite you to come chat, but you better not just be sending text messages saying I'm getting everything wrong, okay? Henry actually follows Upstart much more closely than me, so I've already told him he's more than welcome on the channel. I think he's more of a typer, however, like a Vadim, you know, way too smart but doesn't want to be behind the camera. And Vadim, if you're listening to this, enough is enough. You get on this channel right now. Okay. That being said, yeah, in recent quarters, they actually grew 32% in their revenue. So that ability to start scaling up is quite crazy. The stock did not come crashing down because they grew 32% quarter over quarter. It came crashing down because their guidance was quite poor. Okay. Contribution margin, we spoke about this the other day, absolutely exceeding massive expectations. Operating expenses, I also added in the operating expense changes. They saw the largest decrease in their operating expenses since they've been a public company at, you know, negative $65 million in OpEx quarter over quarter. That's amazing, you know, cost cutting whenever it comes to capital allocation, essentially. So absolutely phenomenal. That is also what's helping their contribution margin. Aside from that, also, you know, the total amount of fully automated loans and these sorts of things, conversion rates increasing. It's all looking so good. Henry, oh, Henry's coming on. Oh, give me one quick sec. I'll be chatting for the next little bit, probably for the next 20 minutes or so. You can come tell me, you know, what I'm getting right and what I'm getting wrong. Here, wait, everyone, we might be getting a nice special guest, so bear with me a moment. Well, I'm not going to do that I'm not going to do it on stream. Not going to be open up my DMs. Bears with me. Bears with me. Bears with me. Okay. The invites have been sent out. I will keep an eye on that and see how that works. I'll have to turn on this. Okay. Everything should be good. Everything should be quite swell. Okay, that'll be exciting if Henry comes jumping on. That's HenryInvests, I think. He'll tell you his Twitter whenever he jumps on. He covers Upstart quite extensively. Very exciting. And then, I mean, hey, if he gets comfortable with that, I might get him on a solo video as well for you guys in the coming weeks to cover more Upstart. Now, before, okay, he's driving. I don't care if you're sweaty, man. Get on the call. No one cares. All right. The guy's buff, okay? He's just been in the gym. That's fine. That is perfectly fine. That being said, I wanted to cover this. And Henry, well, don't be driving and texting, but also answer me this. So figure out how to do both. Pull over. Last quarter, this is Q1 of 2023 that I'm actually showing you right now. 53% fewer defaults at the same approval rate. And what they're showing is based off, and this is a small detail that I found, based off large US banks, with an additional 173% more approvals at the same default rate versus large US banks. The reason why I love this statistic so much versus this market is a scam. Love you. Thanks, Tyler. Really appreciate it, my friend. The reason why I appreciate this statistic so much is because it's comparing it against large US banks. So it doesn't matter what style of approval they're sort of doing, it's facing it versus the largest US banks. Okay. This is different comparatively to this quarter. So same slide, best rates for all. This one, best rates for all. But it doesn't say large US banks. It says credit score only models. 43% higher approvals, and offering lower APRs for those approvals. I don't know why it's so delayed, but it is. Okay, that being said, this is very different. No banks use credit score only models, and let alone whenever you did use the difference between large US banks and credit score only models, which, as we know, if you guys even follow the likes of like SoFi, that just isn't the case. There's so many other factors. That's the one thing that Chris Patel didn't like about Upstart, was the fact that you don't think that a bunch of banks are also building out similar models. Yes, of course they are. Of course they have tons of new data coming in that are actually allowing you to price loans better than the average. But that's why comparing against other banks was so important. Comparing it against this arbitrary credit score only model, which nobody does, of course you're going to have higher approvals at lower APRs. Okay? This has become a problem for me. Like, you're comparing yourself against a not real competitor. Yeah, so Henry just said in the chat, not sure about the schematics, but CFO said lots of applications are being rejected by APR thresholds. So yeah, the threshold, if I'm aware, and Henry will correct me on this, is 36%. They're not allowed to offer personal loans because it kind of gets a little loan sharky past 36%. Large banks can't take that on. And if large banks can't take that on, then there's no one to sell that loan to. And we're not in that business of buying and holding. So yeah, they don't touch anything above that sort of rate. Kind of gets loan sharky. And so if it is above that, they just have to turn away people that are actually applying for those loans. Now, what is interesting, thank you, Henry. I appreciate it. So yeah, 36. What is interesting is what they said is that if they don't approve that person for 36%, they're not going elsewhere. Okay. There's not like, oh, well, Upstart didn't give it to me, so we're going to go over to Pagaya. What they said actually is that if they get rejected here, those people just don't get new capital. Okay. So if they're rejecting them, most likely a lot of people are rejecting them. So that's why the higher approvals is very important, but still, I don't like this. It's based off really weird metrics. They say things here like my screen is cutting it off. Began using cash flow data as part of the risk model for small dollar loans. Now, cash flow data is stuff that a bunch of other banks use. SoFi's been doing it for some time, but this is specific for their small dollar loans, which is like their way to try to fight back against, like overdraft in a way. This is like, essentially that, going after the payday crushers of the world, which is essentially what, overdraft protection is. You're giving them a small loan, you're charging them to do so. And people don't think about it as a loan because, okay, yeah, you just made a transaction, but your account is at $0. How did you just fund that transaction? Well, the bank gave you that money. Like, that's not your money to have. Your card would have declined if it was elsewhere. So them to give you that money, they're taking a fee for doing so. But now with these new models, they have a better way to price it that is a little less loan sharky. Square is much better than Upstart. I don't know how. Those are so different of businesses. I've also been quite critical of like Chris Hager, for example. And we've been on Twitter discussing this, comparing like lenders to Upstart. Upstart is in the same business model in terms of they sell the same products, but they're not the same businesses like at all. They don't want to hold any loans. They don't want, there's no capital restraints. There's no regulations in certain areas. Like they are different in that way, right? They're not looking for, they do have direct customers, but they're not necessarily looking for a direct customer relationship in the same sense. Like yeah, I don't really agree in comparing the companies. They're operated completely differently. Um, but yeah. Uh, Thank you, David. I'm gonna let the thing come up and read out your thing regardless, just because I'm gonna end up saying it and then it's just gonna repeat itself. So, and Henry, stop messaging, my friend. You better get over here and join the call. Okay. That being said, some of the things that I do think are super interesting, um, like from Upstart, for example, is the amount of lending partners. This actually, Pagaya. Yeah, I mean, I don't know Pagaya as well as I do Upstart to cover them. I mean, a lot of their numbers were quite exciting. Like, for example, I think whenever I was looking through them, um, it's quite exciting to compare those two companies side by side because they went through similar macro environments, right? So whenever you're comparing them, like revenue year over year for Pagaya grew 8%. I thought that was absolutely phenomenal because you look at something like Upstart, and they were down 40%. So we're talking about all this quarter over quarter stuff for Upstart, how the macro for them is improving. But that being said, Pagaya is seemingly growing even year over year, which is, yeah, they're continuing to add new lending partners where Upstart really isn't. They had 100 lending partners last quarter. They have 100 lending partners now. Pretty sure they gained one this quarter and they lost one or something like this. It was quite weird. Dealership partners, like this is another thing too. From what I could find, and I'm new to looking into Pagaya, but from what I can find, that Pagaya is much newer than Upstart, and in the way that they're actually getting into the dealerships and the HELOCs and these sorts of things, that they will become a much more diversified business. Now, they're still going to be 100% dependent on macro, but at least they'll be diversified across different products. The reason why this is important is here. Okay. Upstart dominates this personal loan business, but now they're starting to get into auto and dipping their toes into some of the home loan business. Okay. Even getting into things like the small dollar loans is kind of opening up into a completely different area as well. And like I said, this is an unlimited scalable business where they can be going after, you know, really, if you're dealing in fully automated loans at 87% of the time, hopefully that goes even higher. If I'm not even incorrect, the small dollar loans, like the automation's like 98% or something like this, Henry will correct me, but it's much, much higher than the rest of the business. The scalability in terms of meeting applicant needs is insane. So the different industries that you're getting into shouldn't actually impact each other and won't have necessarily nearly as high of impacts on operating expenses as other businesses like SoFi. Like for SoFi to get into multiple different lending areas, you need specialists in every area, support teams, and full on just like teams in every area. Upstart, of course, will have that too, but at much higher contribution margins at smaller teams, right? They even compared themselves to Google during their earnings call, saying how nice it was that the company is making a ton of money while everyone is on vacation. And yeah, I mean, it's 100% macro right now is what I'm finding. This company is seemingly like it's able to execute. Yeah, who knows? Oh, I think we have someone backstage. Here, wait, let me bring them up. Henry. Wait, I can't hear you. Why can't I hear you? Okay, go ahead. Can you guys hear him? It's showing the bar is raising, but I just personally can't hear you. I don't know why. That is super weird. Can anyone hear him? Okay, speak now.
I'm speaking.
Oh, I got you now.
Can you hear me?
Yeah, I got you. Perfect.
Oh, perfect. There we go. Yeah,
Great,
what's up,
great.
man? Happy to be here. It's kind of impromptu. I wasn't expecting this today, but
Yeah, no, I'm happy you can make it. It's a bold move. Just going straight from the gym onto
yeah.
the show to talk about an investment that you've been in for how long now?
Uh, since the low is so probably like 4 or 5 months, I've really been going hard on Upstart, just playing the cyclicality of it, basically.
Right.
But yeah, I think people are very quick to write off Upstart as a poor investment just because of the share price when they don't have a real comprehensive idea as to how the business works and that it's structured to somewhat be leveraged towards the Fed funds rate.
Yeah.
So I think it's one where you have to really take your time understanding and analyzing it. And when you start to do that, you can see how the pieces come together. But very difficult to hold in a sizable position considering it moves at a ridiculous clip. I mean, what, 12% down today, intraday, something like that. So
do you think that this stock deserved a 56% pull off of its 52-week high?
Are you talking from 71 down to where it is today?
From 72.50. I don't even know if you were in support of it being that high this early.
No. But I tweeted out multiple times once we surpassed $30 the first time that the stock was overextended, and then it kind of just played shorts. But I don't think it deserves to be down this far. If you look at the actual report which they published, a lot of the numbers were quite good. They reduced losses by as much as 75%.
Here, wait, let me try a little something. I'm going to try to get some video and audio here.
Okay.
Look at that, eh? Okay, can you see that or no?
I can't see anything on Streamlabs.
Oh, okay. Okay. Well, I'm looking at the slide deck.
Okay.
Is there a certain page that, for example, like I'm looking at the Q2 2023 summary right now. Is there something that
Well, that's fine. We can start there. Let me just see if I can pull that up too. And so I can talk about it.
Yeah,
but,
if you want to tell me page numbers and stuff, we can work.
Yeah, sure. So, okay, I have it pulled up now. If we just start on the Q2 summary, we can see that income from operations wasn't too much of a big deal, but contribution profit was up substantially. Net income rose substantially. It was like negative 121 million in the first quarter. So they reduced losses like really heavily. And keep in mind, at this time, the Fed funds rate is still increasing and lending conditions are getting tighter according to their UMI, which for people who don't know what that is, that's the Upstart macro index. And
wait, that's over here, right? Yeah. Okay.
That's going to be a couple slides down.
Yeah.
And that was something that was really talked about by analysts in the call. I think what they were trying to do was bait management into seeing if this could be a really good forward-looking indicator for how the business's Upstart's loans were going to perform. And that's kind of the inclination that I got, is that a lot of their loan performance is going to be tied to these UMI numbers, which they're releasing later on. So they're like a month or two backlogged so that you can't get a total clear picture into what the business is doing. Something bearish is that they were asked about July's numbers, and Sanjay, who's a CFO, didn't seem too optimistic. So it sounds like credit losses might continue to be somewhat elevated for at least the recent future. But the way that Upstart is structuring their business now is, if you look at their marketing spending too, they've cut that by 77% recently. So, and I mentioned it in the comments, they spent a fourth of the committed capital that they received in Q1 on originating loans this quarter, roughly, according to Sanjay. And so that gave them 32% revenue growth. And they guided only for pretty much nominal revenue growth, which was 6%, and they were going to give back some of the ground they made on reducing losses.
So wait, say that again. What was the beat for revenue versus guidance?
Well, so they grew revenue 32%,
and they guided for 6.
No, I'm saying next quarter they're guiding for 6.
Oh, okay.
But they did beat on the top line this quarter for almost all metrics.
Yeah.
And they had somewhat of a soft guide. I think it's 140 million they're estimating in revenue, and the street wanted 155, something like that. But
right.
I think what we're seeing is Upstart cut costs really, really quickly. at an impressive rate, and they've kind of tapered off on their expectations for growth short term, which, I mean, basic stock market economics is going to result in multiple contraction because it's not growing as fast as what people think. But they're setting themselves up for long term success by preserving losses, continuing to work on their underlying models, and the data is still working. So I wrote somewhat of a shameless plug, and I hope it's not too much of a big deal, but I wrote a 20-minute read on the recent quarter for Upstart, going through all of it. And so you can find that on my Twitter at HenryInvests. And if you look at their delinquency rates, they have gone up. Now, FICOs have gone up as well. And you had mentioned earlier comparing it to FICO standard
Yeah,
lending versus banks. Let me see if I can find the slide number for you. So I'm looking at slide 14, where they have
sure.
that chart. And so those increased. Upstart's risk grade default rates increased, but so did FICO score default rates. And when you analyze the data and you compare it quarter over quarter, which I outlined, what you'll see is that Upstart is still outperforming in every single category, with the exception now of E minus and 639 or below for FICO. So FICO is outperforming in the most subprime of subprime borrowers. But something to note is that Upstart has a larger customer base in that category, and they're serving a broader group of people, which includes minorities or people who have literally no credit history. So the spread of about 0.8% is somewhat nominal, or not necessarily a huge deal. Um,
Right, right.
so I hope that makes sense. The models are still performing actually quite well compared to competitors.
Yeah. So I like, what is aside from just this point, because I even am seeing it in the comments right now. This company does have the ability to absolutely perform amazingly in a perfect environment. Is that the style of stock that you think is? I mean, you are invested, but is it worth your capital if, for example, um, you know, in a cyclical environment that it could be down 50% of the time if, for example,
Right.
the macro is good half of the time or something like this?
Yeah, no, it's not worth your capital if you don't have a strong thesis and you can't stomach wild swings, which is why I've allocated a somewhat small percent of my portfolio towards it. But I think to counter that, in exchange for the cyclicality that you get and the volatility, you're also given the chance at outsized returns. Um,
Right.
so it kind of evens out. I would say that risk is somewhat fair, especially the lower it goes. Um, people tend to have this big fear that it's going to go back to $12 a share after this recent report, which I find very hard to believe, considering that they've got committed capital pouring in. We have more clarity on the macro now. It appears that the Fed is, I would say, at peak Fed's funds rate, if not very, very close. So they have that going for them. They've reduced losses. They're still guiding for revenue growth for next quarter that's 40% higher than what it was in Q1.
Right. Right.
Um, and people like to say, hey, revenue is down 60 some odd percent year over year. What do you think happens next year, or the year after that? They're going to have comps the other way, where it's going to be revenue grew 85% or 90%. And for people to sell off the stock based on revenue growth concerns is really foolish, because you would have known that comparison number before the earnings even came out, just based on looking at the analyst estimate. So
So
that shouldn't really be a testament to your position on Upstart.
then let's talk about opportunity cost. What is either management saying, or what are you saying in terms of uh, how long it will potentially take in order to, you know, get the macro back to normal, where the stock can actually start rising again? Um, is the If there is an opportunity where the lending market gets so healthy again that this stock can go back to $400 a share, is that even possible? How long do you have to wait until this investment of yours actually pays off?
So you're asking me a tough question here.
Of
I
course,
think
yeah.
it's impossible to pin it to a T, but um, I think capital markets bottom before the Fed funds rate will be cut. and before the economy bottoms as well. So I think you're going to see a lot of institutions load up on riskier loans when the federal funds rate is looking like, or people are projecting that's going to trend down because they can get that higher yield. And if you want to come ahead and say, well, borrowers will refinance their loans, that's fine too, because Upstart will get a loan origination fee and transaction volume fees on that as well. So I don't really see that as a big deal.
Right.
I think that the cyclicality of Upstart's business has bottomed. I think the implementation of auto, which grew into 12 new states this year, as well as the pilot program for HELOC in Colorado, further reduced the cyclicality of Upstart's business because their bread and butter is core personal loans. These are auto and HELOC, home equity line of credit loans, are ABS loans, asset backed securities. So they're somewhat counter cyclical to unsecured personal loans. So,
So, but there was a couple cohorts back in their personal loan segment that had underperformed before. Are you worried that these new style of loans that I know have been sitting in sort of like their R&D sort of stages? I know that they hold loans to test those cohorts, but do you think that there's a chance that they underperform these new style of products?
like new loan offerings.
No, I mean like autos and HELOCs, things that they're not necessarily as seasoned in as they
Yeah.
are for personal
Okay,
loans.
I got it. Yeah, those will underperform at the beginning. And this once again, the CFO Sanjay said that last quarter. They're structuring. I think he said it's an ABS deal to get some of the initial auto loans that they had made off the books, and they're selling that at a loss. And he said in the conference call that investors could think of that as being attributed to the R&D for the actual program, which I can take it or leave it. I'm not necessarily super impressed by that. But yeah, upstart loans at the beginning will certainly underperform because they're taking a different stab at kind of the age old way of evaluating credit.
Yeah.
I think if the business model, I think bankruptcy risks are pretty much zero. Cross River Bank exposure has vastly decreased. There was some big fear about like a cease and desist notice
Yeah.
that
So
Cross River Bank.
do you want to add some clarity to that? Because Cross River Bank or whatever was such a large client to them, similarly to Citadel for Robinhood,
Yeah,
that
right.
people were worried a little bit of a lot of, you know, very concentrated risk having one large client. Do you want to add some color onto that just so people know
Sure.
what you're talking about?
So the first thing I'll say is Cross River Bank is still a large client, but the exposure, and that's like the number one risk factor that Upstart has in their, I don't know if it's a 10Q or whatever they officially call it, but that exposure has gone down every quarter. I don't have the numbers offhand. I could pull them up. I've written about it before. Those numbers have decreased. Exposure has decreased.
Is it
Um,
50%? Is it 10%?
oh, it's closer to 50. It's closer
Okay.
to 50. But that number I think was in the high 60s earlier too. So it's still pretty sizable. It's fallen. Um, so before Q1 earnings on May 9th, Cross River Bank got a cease and desist notice from I think it was the FDIC for engaging in unsafe lending practices. Now, Cross River Bank does a bunch of crypto lending, fintech lending. Obviously, they're partnering with Upstart.
Yeah.
So the very conventional thing was to say, well, Upstart practices are predatory, this, that, right? And so when you read the filing, what it actually says is they entered a consent agreement. Cross River Bank did with the FDIC, which means they neither agreed to or denied the claims that were made, but decided to amend the lending practices that were under scrutiny. When we're not privy to exactly what those were. But those deadlines that the FDIC gave Cross River Bank, they had due dates as close as 30 days. And so when Upstart reported, that's why I was very nervous holding into Q1 earnings because I didn't know if that was going to be a big deal. But with Q1 earnings going fine, and now Q2 earnings with still revenue growth and no mention of Cross River Bank regulation issues, and those deadlines being now way in the past, that bare thesis to me is completely gone in the sense that Upstart's doing unsafe practices according to the FDIC with Cross River Bank. So I think that's gone. I think the exposure risk is still obviously there, but once again, that's being mitigated. And so when you find a stock like Upstart, it's not smooth sailing. Obviously, you're going to have risks. So
Right.
yeah,
So I
something you
had
should be aware of.
I was reading about some bear points that came out that Supposedly, and I haven't read into this, but that the committed capital that people thought was actually coming in Q1, now that Q2 has come out, has been kind of like not as committed as people thought. That not all the money. Can you explain that, and what why are people sort of getting fearful about the comments that were made about the committed capital?
Yeah, so it sounds like committed. So they said there was a press release after Q1 that said Castle Lake, which is an institutional investor, was going to give Upstart up to 4 billion in committed capital. It looks like, from everything I've read, that 2 billion has officially been secured, and they
Okay.
used one fourth of that, one fourth in Q2, one fourth of the 2 billion to grow revenue. Once I'm not 100% sure, but if I'm saying what I think is correct here, and so it appears that the remaining committed capital might not be concrete, but that was also alluded to when it said up to 4 billion in the press release. And Upstart made an additional announcement this quarter. I'm going to direct you to the slide here so that people watching can see. Basically, it's a slide where they said that they were going to share some credit risk with their bank partners. This is going to be slide 20.
20. Okay.
Yes. And so what to me what this is a proof of concept. So Upstart's saying we are going to onboard some of the credit risk. In exchange, we're not going to get any profits from it, which is what Sanjay said in the conference call. It might go on the balance sheet as like some obscure income type thing, but it wasn't going to affect the top line, is what it sounded like. But what it was going to do was going to show people that were partnering with Upstart or looking to give Upstart capital that we're so confident in this, we'll onboard half of the risk. We'll show you that our models are working, this, that, right? So proof of concept. And the interesting part about that, when I had first read it, I was like, oh, okay, this is somewhat speculative. We are onboarding
Right.
credit risk. This is not ideal. But it appears that those vintages have been performing actually quite well. So they invested 40.2 million in risk sharing, in a risk share agreement. And as of June 30th, they're estimating that to be worth 51.7 million, which is like a
Right.
28% increase, which would allude to or infer that their credit models are actually underwriting rather well, and that these loan performances are doing quite well, which should hopefully bring in more committed capital, which is a necessary lifeline for Upstart's business. But you're right, concerns about that committed capital definitely contributed to the share price fall that happened on earnings. Yeah, definitely.
Okay, so they're taking on higher risk to try to bring on more clients, but in return, they're not expecting new revenue from this
Correct.
$40
That's my
million
understanding.
that they're taking on.
Yeah, but I also think $40 million is like not a huge deal for a company
No,
of
no, I
Upstart's
agree,
size.
but if it like I agree, 40 million is not a problem, but is this a scale? Like, do they want to scale this style of
I hope not.
like is this sales and marketing? Like, what is that? You know what I mean? Like, are
Yeah,
they gonna try to
I
scale this
um
practice?
I don't think so. I could be wrong on that, but I think this is we're getting near the bottom of this or the cycle, and we need to prove to people that you should be buying our high yield loans versus somebody else's, because there's a surplus of high yield potential subprime loans available.
Right.
And so Upstart vintage performance went up year over year like 800 bips or something. So loans are performing well or much better than they had been. And I think it's just a proof of concept to try and really bring in that committed capital at the lows so that they can have so much money ready to go at the beginning of the next boom. And when institutions are risk on and banks are risk on, that they should be poised well for future growth. Um, and with cost cutting measures in place and sort of tempering that growth temporarily until the all in moment comes, I think they're set up to grow profitably. Um, I think they
Right.
were adjusted EPS positive this quarter by 6 cents. Um, and back in the good days in normal times, or maybe slightly better than normal times, Upstart was a very profitable stock. I mean, they were posting EPS of 60 cents a share in one quarter, I think, if I remember that correctly.
Yeah.
And
Yeah. Here, wait. Let me. Okay, wait 1 sec. Let me bring this up on my slide because
sure.
maybe I can help bring this up.
And I'll just chime in real quickly. The share structuring of Upstart makes it so that it's very shareholder friendly because there are not many shares available. So when Upstart posts 60 cents of EPS, that's vastly smaller profit than a Palantir or a SoFi, who's going to post 4 to 5 cents of EPS because they have many more shares outstanding. So it's not even that Upstart is turning a huge profit. It's just that there aren't many shares available. So those numbers are higher and it's super scalable um, in the long term. So it'll be one of those companies that probably has like $8, $9 EPSs if everything works out.
Yeah, it is funny, the way that you look at this company. Like, this is what I mean by like blitzkrieg scale sometimes. Like in Q1 of 2021, they brought in 11 cents on earnings per share, then 40, then 30,
Right.
then 60.
Yeah.
And
61,
then
I
they
think.
proceeded just last quarter, they did $1.58 in negative EPS. It it
Yeah.
yeah.
It's a
But
double edged sword.
it is a double-edged sword 100%.
Hmm. And just as people can be too exuberant at $400 a share, people can be too pessimistic at $12 a share as well. That's the cyclical nature of Upstart.
So
Um,
also tell me about this then, because um like some of the key operating metrics, like I know that I've been really pointing out the contribution margins, the operating expenses cutting, because I remember whenever I was talking with From Growth to Value, that was one of the things that he is most excited about, is that because of their workforce cuts and these sorts of things, and you're kind of getting to need less less new loan originations in order to hit profitability, because they're kind of
right.
getting more efficient. And also this high level of fully automated
Automated
loans, I
loans.
don't think
Hmm.
people are getting nearly as excited about, because it has gone up before and they've brought it back down. So I don't know if people are getting confident, but from what I was looking at before, they kind of ramped it right up like in this extreme level and then had to bring it back down. This seems to be more of a slower, steadier ramp, as maybe they're getting their models a little bit better.
So let me touch on this. A couple
Please.
things. Do people realize how crazy like an 89% fully automated loan rate is, where there's no human interaction?
Yeah.
That's Upstart can grow very capital light. So that's the first thing. And when you're looking at just loan originations in general accelerating, they're poised very well for that. And could you just repeat the last part of your question so I can really hit home
Oh,
on it?
um, I don't
I kind of
even
I was
just the
sure.
fully automated part. How high do you think that's going to get? What do you think?
Sure.
Uh,
Okay. Here's what
where
I
are
got my
their
train of thought back.
expectations for contribution margins? Like if you continue to raise that up to, I think what they said, like their hypothetical max would be like 98%.
Yeah.
Uh,
So, okay, I know where I'm going with this. So I think Upstart's contribution margin is really high, and I think that sets them up in a position to kind of reduce that um, themselves and give that margin back to their bank partners and still be extremely profitable, so they can give more reward to their bank partners,
right.
which is important. And I think when people wonder about the cyclicality of this business, think of it this way: in 2021, they were still pretty unproven. When you go through 2022, which is hell on earth for a company like Upstart, your models are learning the entire way down. And when people say, "Can J.P. Morgan try and make an Upstart?" Of course they can try, but the data is worthless if it's not programmed. If it doesn't know what to do. So Upstart models are learning on the downward pressure of this, and they're going to become more accurate and outperform as time goes on. So I think the cyclicality of Upstart that we saw in this down cycle is not likely to be seen again in a future down cycle because models will be able to pick this up quicker. Um, and so that's going to prevent a lot of that from happening, as well as ABS markets with auto and HELOC. It reduces the cyclicality of Upstart's business. And with more committed capital pouring in, with resiliency shown, they're positioned to have they have more bank partners now than they have in a long time. And I've listened to, I would say, probably every Dave Gerard interview out there. Um, People have very split opinions on him, mostly because he lost investors a lot of money. But he said that there will be a day in the future where Upstart starts growing partners so quickly that it'll be like a slap to the face and you'll have no idea. And what he means by that is like they'll 10x their partners in a year. So
Mhm.
from like 100 to 1,000, very possible. And so um,
I honestly feel
it's
like the scalability of this company is what blows me away the most. Like,
it's infinitely leveraged.
Yeah.
because they're not holding any loans. They underwrite the loan, they sell it.
Well,
They
they
well,
have.
right, they have, but in traditional times, they're
Yeah.
not holding the loans. They're selling the loans immediately. They're getting an origination fee, and they're accruing interest from interest payments on borrowers. So this, I'm not saying that this is going to happen at all, but if you assume that Upstart really does work, it outperforms FICO in every metric possible, and it's totally adopted worldwide, Upstart is getting a piece of every single loan that's originated, even if it's held at 150, 250 different banks. So if JP Morgan partners with Upstart, all Upstart is doing is basically collecting royalties on loans that JP Morgan is carrying the risk of. So the idea
So,
of Upstart is so scalable.
but also Upstart has to perform so much better than JP Morgan's owns models because they also have to get over their own fee, right? They do take
Right.
a premium.
Now, Upstart started in 2012 as an income share agreement lender, which was kind of a shitty idea. Oh, can I swear on this or?
I don't
Sorry.
prefer it, but it's okay.
Okay, sorry. Yes,
No, all good.
It's kind of a bad idea, and they kind of pivoted, I think, in 2014 because they were running out of cash, and so that's when they started developing this new model, which is what we're seeing today, which is underwriting based on non-traditional metrics to serve non-traditional people. And so that's a really big head start. And people are also thinking, well, JP Morgan has so much data, Upstart has no data, they're a small fish. And yes, Upstart is a very small fish at like a 2 point some billion-dollar company. But
Right.
I mean, just looking at slide 3, $34 billion in originations. Like, you don't think that comes with any data that, when modeled over 8, 9 years, is going to be proprietary? So I think that Upstart, and they even said it themselves, UMI is a proprietary metric to evaluate how likely a borrower is to default. They instituted a new program this quarter. Um, I don't know much about comp size, so I'm probably going to butcher it, but it's, see if I can find it in the article that I wrote. It's basically going and looking at backlogged loans that they already underwrote and basically re-underwriting them with their new models and seeing how they would perform. And that way they can test and see how new loans might perform without having to wait to see how they will actually perform. So it's a kind of way to get more data by looking at data that they've already accumulated, if that kind of makes sense.
I can't believe the level of loans that they're writing that are like recurring customers.
38% or 28%?
Yeah,
something like
that's
that.
nuts.
Yeah.
Okay, Eddie's gonna kill me if I don't ask you this. He's messaged it like 5 times in the chat.
Oh, Eddie.
Okay, I'm pretty sure it's Eddie. It's Frugal Buck. I'm pretty sure that's Eddie.
Frugal Buck. What's up, Frugal Buck?
Tanner, ask him about buybacks for like the 6th time. So go ahead.
Oh, okay. So that quarter was announced, but Upstart did authorize like a ridiculous buyback. 400 million, I think, was the exact amount when the share price was about $100 a share. And I wasn't a big fan because they were already losing revenue, and it was like, well, if you can't grow revenue right now, why are you buying back shares? I have similar distaste for Palantir's recent buyback, but that's not what we're talking about here.
But similar to PayPal though, were they buying back shares or they got approved for a buyback program?
So they bought back a lot of shares.
Okay.
They bought back I can get the exact number for you. If you give me a minute, I'll continue to talk. But they bought back an obscene amount of shares at $30 a share was their average.
Wow. That sounds familiar, doesn't it?
Yes. Now, so the company bought back shares at $30 a share, and I'm going to find the exact number for you. And keep in mind, this buyback was authorized at $100 a share. So they didn't just buy it right away. So management, they can talk whatever game they want on the earnings call, but they knew to a degree that their business was cyclical and that the stock was likely to get punished because they waited a couple of months before they acted on the buyback that they initiated. So I'm very close to pulling up the number here.
I got to correct while you're looking that up, a comment in chat.
Okay.
As Your Blue said, Bed Bath & Beyond bought back $6 billion of stock. That didn't age well. This is one of those things. It's not just because buybacks are issued doesn't mean that it's a foolproof plan. It's a great sign. Probably majority of the time it's a great thing, but not every time is it a great thing. So a single, company that didn't perform well and it also fits under that category does not mean anything. Sorry, but go ahead, Henry.
Yeah. Um, yeah, that's the same thing that I get with insider sales. There have been very little insider sales. If you look at it,
Oh,
almost
I want to
all
talk about
have
that.
been. I'll get to the number here, but let me just finish this.
Yeah.
All of the insider sales have almost all of them have been direct, which were pre-authorized at IPO for future dates where management had no idea what the share price was going to be. Now, there are a few exceptions. The CFO Sanjay has sold like 20,000 shares here or there, but those are pretty nominal amounts. Going into the going into the second quarter, when people were screaming insider dumping and blah 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 as the share price rose, simply not true. In fact, I think the only non direct or the only direct transaction was an insider buy from a board of directors member named Cooper Wharton, who bought like $45,000 worth of stock at like $26 a share. So to me, when somebody says that Upstart has huge insider selling, I just totally discredit that argument because it's just simply not true. So Upstart repurchased 5.9 million shares, or about $178 million worth of shares in 2022. That came down to about an average of $30.17 a share. And when they reported the next earnings after purchasing these shares, they were down 44% or $79 million on that purchase. And that was as of the February 14th close of 2023. Of course, now they are up on those shares. Um, and and so they did. I mean, 5.9 million shares is nothing to scoff about. So shares outstanding has gone down. It has ticked back up nominally in recent past due to SBC.
Yeah.
But if I'm a business like Upstart that's so cyclical, what am I going to do to drive employee morale and get employees to really want to work there? I'm going to issue SBC, and they're not doing
Well,
it
I
at a
mean,
crazy rate at all.
like any AI, like this is an AI company, right? Like this
Yep.
is not a lender. This is an AI tech company, and people need to understand that they're just tackling the lending problem. Um, of course, you're going to be paying out probably some SBC to a lot of
Mm-hmm.
great engineers. That is another question. So before we actually jump in, because I did want, or yeah, I'm already shifting the conversation a little bit, but then I'll get back to insiders, institutions, short interest, stuff like that. But I did also want to talk about one key engineer, and I wanted your opinions on one named Paul Gu.
Oh, I love Paul. Paul is so for people who don't know about Paul, he was so young. I think he was 15 or 16. He met Dave, and Dave had to sit down with Paul's parents to convince him to let him work with Dave on Upstart. Paul is essentially a computer science genius. He is chief
Like a
tech,
literal genius, like a
literal
genius.
genius. Like
Yeah.
he was I think he went to Yale or Harvard. He was accepted into the Peter or invited into the Peter Thiel protege program by Peter Thiel himself as a minor. Do you know how crazy that is? Like that is
Yeah.
he's a literal genius. There are some interviews of him online. Just listening to the man talk, you can tell he's of extremely high intellect. But Paul Gu is I wouldn't be surprised to see him leave Upstart someday in the future and start his own company because he's extremely
You know what?
intelligent.
I thought that as well, but he's been there for a long time
He's
now.
been there for a long time. I
Like
know.
longer than you would suspect from someone like him.
I think he has stock warrants at like $150 a share or something like that. So I think he might want to see the business prove itself a little bit more before he leaves. But Paul is essentially the one who's writing all of these models. He's been doing so since he was a minor. And my good friend Owen at Owen DeBoard 2 on Twitter, because he's been my right hand man in all of this. Anything that I know, he knows as well.
Sure.
Paul's net worth is like almost all in Upstart. Like I think he's worth $10 million and he holds 9 million in Upstart stock. Similar, Dave Gerard is worth an obscene amount, a couple hundred million, I think, and or maybe even more now. I don't know because the share price fluctuates so much, but he's like 80% in Upstart. And the other founder, like Anna Councilman, I think
Yep.
is her name, somewhat of the more not so well known founder because she's not I don't know, whatever. She's not really as well known. She's like basically all in too. So and Sanjay, the CFO, is like 7 of his $8 million net worth, and of course these numbers might not be exactly right, but the percentages are pretty close. Is in Upstart as well. So these people are basically all in with just a little lifeline of support in case it goes wrong.
Eddie
So
is saying that he doesn't believe Paul has any warrants left, but
Eddie's right. I think Paul converted his warrants as a measure. Eddie's right. I think in Q4 or Q1, Paul converted his warrants into a straight salary to reduce stock-based compensation, and that was highlighted in one of the quarters. So
in
thank you, Eddie,
Q1,
for bringing that up.
it's why expenses were so high.
Okay, yeah, something like
I
that.
don't know. I don't know. This is why, you know what? I got to get both of you guys on a call and we can do like an awesome Upstart podcast or something like this.
Yeah. Eddie is, I love Eddie.
You know what? You got to be on camera more. You're great on camera.
I appreciate it. I had a little stint on YouTube, and Upstart went. I started buying Upstart at like $19. I think it might have been $21, and then it went down to $12. And I just got so sick of the comments that were like, "Upstart's down 50% since you said this," and blah blah blah. And I was like, I understand the business. I just didn't want to sound like an idiot trying to explain it to other people. But I think I've somewhat overcome that fear a little bit here, maybe with the improvement in fundamentals.
Dude, I was buying SoFi at 14, walked it down to 4, looking like an idiot, back up to 10, and people celebrate now. So, I mean,
it is what it is.
Yeah, honestly, I've been telling people since the start that I'm not even worried about the stock prices. The stock price only matters for me whenever I'm buying. If I can buy at great prices, the fluctuations while I'm holding does not mean a thing. Yep. Like, another thing, I know this is off topic, but I really want to state this. Like, what would we have preferred as investors, just talking about SoFi here, if we were buying at $10 and it never have moved for that, year or 18 months or whatever to $10 again, or for it to have dipped to $4 and allow us to actually DCA on the way down? I would much rather have preferred what happened. It just doesn't feel good in the meanwhile.
Yeah, like all the money I put in my brokerage account, I write off immediately as I'm not touching it for however long. Like I welcome down prices. In fact, I would, barring something unforeseen in my Upstart thesis, I would say that I'll probably ride it to 0 or I'll ride it all the way up, because I'm not worried about I'm not going to sell. I'm up pretty sizably, but I'm not going to sell at like a 50% loss just because of fluctuations. Like, I'm in it for the long term. I think the business is going to work, and whatever volatility that comes with, I'm willing to stomach that to a degree. So I'm not super worried about. I mean, Upstart either works well in the next decade, and you're going to see that reflected in the share price, or it's going to go absolutely nowhere, and that'll become pretty evident if the Fed funds rate goes down and the business goes nowhere. That's going to be the crossroads right there. So,
well, one of the things that you said is so important. People need to really realize this, and I agree with you. Bankruptcy is kind of off the table. This is not a lender. This is there's no bank run here. Like people don't quite understand that. Whenever they're originally looking at the company, what you have to understand is every company has an ability to go to 0, but that would be because their algorithms are faulty, because their customers don't want to use them anymore. It's not really a bank run similar sort of situation. It has nothing to do, like completely different businesses. One's a tech company, one's a bank. That's why I find the comparison so weird.
Yeah,
with like other companies like that.
I mean, you could compare it to Pagaya, which I don't know enough to talk about here.
I was going to ask, okay.
But I know Pagaya is mostly in the ABS markets, whereas Upstart is more so in unsecured personal loans, and they're trying to diversify that. But Pagaya seems to be a more counter-cyclical way, similar business. I don't know enough to give you the full picture on it. I own a very small amount of Pagaya as like my queen to my Upstart king, if you want to put it that way. I think I said that to somebody today because Pagaya did well. But so
okay. No, because I just I've already ran the show 30 minutes over overtime. I do want you back though. You're a great speaker. I'm not going to fault you for the way that your mic is set up backwards and upside down.
Well, I just ran in here. I haven't done YouTube in forever, but yeah.
Yeah, no.
Put it this way.
Yeah, but it's so my mic faces at me. Your mic should be looked at like this. Yes, my friend.
This? Okay.
Yeah, and
Is my audio good though? Like, can you hear
it
me
is
or no?
now. Now it sounds phenomenal.
Okay, there we go. Okay,
And then
my
just
bad,
tighten the
guys.
screws so it doesn't fall over on you.
Hopefully, my Upstart analysis and my ability
Stop pointing
to
it at yourself. Pointing it away from you.
hopefully my Upstart analysis and my ability to which way do you want my mic? Which way do you want my mic?
Like, imagine if it's the bottle, you want to be talking into it like this, like the way you see stand-up comedians, like away from you. You're pointing it at you, point it like this. You're talking into the side.
I'm not following. My YouTube experience is minimal.
All right, man. It doesn't matter. Anyway, I'm wrapping up. I wanted to also say, before we go, about Upstart as well, there's a 16% ownership in insiders. Institutional holdings, this is where there's a lot of bettors against this company. 36.8% is institutional, and the percentage of shares outstanding as a percentage of, short shares is 31%, which probably majority of that is institutional. However, institutions, I would say, hold a lot less long-term and also like to play a trade. I would not and this is less about Harry and more just about my own video here. I am personally not buying the company right now. I'm not a shareholder. I believe in their vision. As a short-term play, I think the macro probably lasts until Q4, Q1. And then I think like there's a real opportunity for Upstart to do exactly what it did before, going from $10 to $70. That's the magic of this company. Unlimited leverage, like what Henry said, right? So right now I'm not buying. I've got a very close eye. And as this company starts to, if it does dip a little bit lower, I might be a potential buyer or potentially hold out a little bit longer, but not currently touching it right now. Anyway, Henry, thank you so much. I'm going to contact Eddie and yourself, and potentially maybe we can set something up if you're wanting to be on a little bit more YouTube, but I'm going to pressure you that way. Aside from that, thank you, everyone. Thank you, Henry, for joining us. Can you shout out your Twitter really quick?
Yes, follow me at HenryInvests on Twitter. Please, trying to get to 1,000.
That's an easy tag right there. Okay, perfect. Yeah, Henry did kill it. And Eddie's quite knowledgeable as well, so we'll have to jump or get him on as like a trio here. But anyways,